Hi everyone, welcome back to Mutual Understanding. It is the 27th of March 2026. It's 9:30 in the evening. It's super early. Let's dive in. Welcome to this week's APAC market wrap. We are seeing intense friction across the APAC credit markets right now, and to understand exactly how the rules of engagement are changing, we need to start in a courtroom. A major legal precedent just dropped out of Australia. The New South Wales Supreme Court issued a heavy judgment ordering the liquidation of Tahmoor coal, forcefully removing and replacing the previously appointed voluntary administrators. This is the latest chapter in the ongoing GFG Alliance collapse. Just to contextualize this for those who aren't in the restructuring weeds every day, GFG is a massive global steel and mining empire owned by billionaire Sanjeev Gupta. A few years ago, their primary lender completely collapsed, wiping out billions of dollars in the financing overnight. That triggered a global domino effect of insolvencies, fraud investigations, and desperate restructuring attempts across GFG's web of companies. Because GFG operates as a highly complex, privately held network of businesses, courts are incredibly suspicious of how they move money around and try to save themselves. And that brings us to the broader implications of this Tahmoor coal ruling. With the NSW, the New South Wales Supreme Court actively unwinding voluntary administrators, is the era of rubber stamping friendly related party rescue financing officially dead? The court is drawing a line in the sand, and if you're a distressed company trying to structure a survival deal that heavily relies on insider transactions, expect microscopic judicial scrutiny. The days of controlling a restructuring narrative through a friendly, hand-picked administrators are facing severe pushback. Part 2. Restructuring chess and regulatory wars. This tightening judicial oversight is happening exactly as distressed borrowers are trying to execute increasingly complex maneuvers. Take Modernland reality in Indonesia. They are playing a highly aggressive game of distressed chess, asking holders of their April 2027 notes, which have already been restructured twice, for consent to transfer land security to a Singapore as SPV. To pull this off, they need to raise 20 to 25 million in super priority DIP style financing just to cover the tax hit. Is this SPV transfer a necessary evil to facilitate a genuine asset disposal, or are note holders simply funding a super priority delay tactic to kick a twice restructured can down the road? Meanwhile, Far East Consortium is taking a different route, attempting a soft landing for their cost of capital by working with UBS and HSBC to potentially exchange a $360 million in perps into lower coupon straight bonds rather than calling them at par. And then you have the regulatory invisible hand. Exclusive reports reveal China's National Financial Regulatory Administration just used window guidance to instruct onshore insurance companies to halt new investment exposure to GLP China. To give you a quick primer on who they are, GLP China is an absolute giant in asset management and logistic real estates. We are talking about the massive warehouses, distribution centers, and infrastructure parks that serve as the physical backbone for supply chains and e-commerce across the country. They rely heavily on domestic capital, like the deep pockets of onshore insurance companies, to fund these massive capital-intensive projects. When regulators quietly ring-fence onshore risks and cut off a prime source of domestic capital, who is left holding the bag? By keeping this off the books but strictly enforced, regulators are severely restricting GLP's liquidity toolkit and pushing the refinancing burden entirely onto offshore channels. The next part, the covenant deep dive. West China cement. While Modernland needs super priority cash and GLP battles regulators, over the high-yield industrial sector, the battle is entirely about covenants. Let's look at the most contentious situation on the board, West China Cement, WCC. WCC is in preliminary talks to sell certain mainland China assets to an associate of Anhui Cement. If this involves their flagship Shanxi operations, it's like a seismic event. This deal would effectively strip WCC of 60% of its revenue and nearly half of its gross profits, leaving bondholders exposed to a company whose earnings are suddenly concentrated in highly volatile African frontier markets. If management can legally leak value out of the guarantee perimeter without triggering redemption, how bulletproof are these asset sale covenants really? Proprietary valuations put the China equity at around 3 to 4 billion renminbi. But here is the critical legal analysis. WCC's incredibly loose asset sale covenants give management massive latitude. They could reinvest the proceeds or execute a cashless swap without ever triggering a mandatory redemption on their 700 million of outstanding senior notes. We have mapped out 4 distinct routes where value can legally bleed out. Right now, WCC bondholders aren't betting on cement, they are betting on covenant loopholes. Next, we have the macro squeeze and the primary markets. Covenant loopholes are one thing, but you can't analyze these capital structures in a vacuum. The macro overlay right now is brutal. The escalating conflict in Iran is acting as a catalyst, exposing structural vulnerabilities through a compounding matrix of pressures. Sudden fertilizer shocks, energy inflations, Indian rupee depreciation, and higher for longer US rates. The key question is, are we witnessing a temporary geopolitical repricing of risks or a fundamental structural break in the APAC credit assets? The upcoming SG Group bond deal is going to be our canary in a coal mine. We are already seeing primary markets friction. JP Morgan had to scrap a prior round of investor meetings for PLS Group due to volatility. Though market intelligence shows they are finally resuming outreach. Others, however, are testing the waters. GCL, also known as the Golden Concord Group, is coming to market. For context, GCL is an absolute heavyweight in the Chinese green energy sector. They are a massive conglomerate that dominates everything from solar polysilicon manufacturing to natural gas and MG storage. They are marketing an up to 500 million dual currency bond with GC US dollars yield guidance up to 9.8%. In a similar vein, Modernland is sounding out investors for a 75 to 100 million Singapore dollar denominated bond. The appetite is there, but the digestion is getting harder. The private credit disconnect. But here is the fascinating disconnect. While public and primary markets are dealing with this macro friction, private credit is aggressively stepping into the void. Recent intelligence confirms that Jefferies Australia just closed an upsized Australian dollars 180 million term loan for Journey Beyond, feeding into a massive AUD 495 million facility for a Cell-Link tourism portfolio acquisition. Pricing sits at BBSY plus 600 basis points. So why is private credit enthusiastically funding complex upsized M&A at tight margins, while public markets are slamming the door on established corporate issuers? It comes down to asset quality and bespoke structuring. capital is still moving, but only when lenders can dictate the terms and take structural priority. We are seeing this mid-market appetite elsewhere, with Camflash, Sanmar negotiating up to 268 million in private debts to fund its Egyptian unit, and Whiteland Corp privately placing about 58 million in unlisted NCD, non-convertible debentures. Alright, to wrap up, we are looking at a market thoroughly bifurcated by structural quality and covenant strength. High quality assets can still command aggressive M&A financing in the private markets, but stressed entities are being forced into tight corners, relying on legal loopholes, SPV transfers, and complex liability management just to survive. In short, the macro environment is a mess. Bond covenants are basically just polite suggestions at this point, and the only people guaranteed to make money in this market are the restructuring lawyers billing out their Friday nights. Sleep well, try not to look at your portfolio, and thanks for joining this week. I'll see you in the next one. Bye.